Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So you'll see this happen a lot nowadays. The market doesn't always make the 1, 2, 3, 4 pattern. Sometimes it makes this pattern where it continues. And during that time, you're going to see what starts off as a sideways rectangle pattern, looking like I'm making higher lows. So at this point in time, the pattern looks more like an ascending triangle after a few weeks. And if the breakout is to the upside, this is again an indication of accumulation on the sell-offs at higher prices by institutions in anticipation of higher prices still. And in this case, we broke out to the upside and we extended the top of that range, and we very, very quickly rallied from about the 103 to the 110 area in the spot contract. Now, this is the Australian dollar spot contract, the ISE spot. So we had an accumulation lower. We had a breakout into a new uptrend once we were done with the sellers. And we had a higher accumulation and another breakout and another uptrend. And of course, if the market starts to base after an uptrend and breaks out to the downside, several times you can sell off in a downtrend and then base again for a period of time and break out once again and make new lows. So if you see this sideways pattern breaking out to the downside, followed by another sideways pattern that breaks out to the downside, this could be a downtrend continuation pattern. And you can see several chart patterns when this happens. Here's an Australian dollar descending triangle. So when I saw I had a triple bottom down here, I also noticed that every time I rallied up to my downsloping moving averages, I began to make new lows. So I was anticipating, actually, instead of a triple bottom, a continuation pattern to the downside. Here I have some kind of a rectangle that is starting to break out to the downside. We talked about this on several of the webinars that I've done. We were looking for a breakout of the Canadian dollar, the dollar versus the Canadian dollar, to test the 95 support area. So these distribution patterns, every time there's a rally, there's institutional selling on the rallies. And eventually when you take out all the buy orders or the support at that price level, that's when price will start to make new lows. And here we broke out of this rectangle to the downside and continued lower. We also had a descending triangle during the move with the dollar versus the Swiss franc last year. And we had a breakout to the downside from a descending triangle at higher prices, the dollar versus the Australian dollar, even before we made new lows and retraced 100% of the move from the rally in 2008. Now, sometimes when you see this, you're going to say to yourself, okay, well, prices are just going to keep going lower and lower, but they can always become a sideways channeling type of market if an area of support below current price and an area of resistance above current price forms. And then it'll be an accumulation if the breakout is to the upside, or a distribution if the breakout is to the downside. So if all the demand is absorbed, prices will go lower. If all this supply is absorbed, then prices will go higher. So while it's in that sideways channel, this is a good time for you, if you have the proper approval, to think about condors, selling premium, call spreads and put spreads. Here was a bear flag in the dollar versus the euro. We have a flagpole followed by some basing that eventually breaks out to the downside. And once again, this is a sign of distribution. So our fourth stage cycle that I talk about has directional movement and it has periods of non-directional channeling. If it's a stage 1 or stage 3, you can use non-directional strategies to trade, option strategies. If it's a stage 4 or stage 2, which are trending markets, stage 2 up and stage 4 down, then you can use directional strategies. When you reach prior areas of support or resistance, then you should take profits. You can also think about swing trading. And you should always check your VIX, your overall volatility, plus each one of the currencies' volatility. On the ISE website, we have live vol, and you can check your currency pairs just to see if the currency pair that you're thinking of trading is where the options are expensive or cheap. So in the case of the VIX here, every time the VIX sells off and was selling off down to this area of support near 20, option premium becomes cheap. And of course, when we have these panics like we had a couple of times in the last couple of years, this is when option premium becomes expensive. Same thing with your currencies. Also, make sure you check your level of approval, because if you're just a level 1 or a level 2, you can trade certain strategies. If you're level 3, 4, or 5, you could take advantage of other strategies. So use that chart and a chart like this, and then combine that with your level of approval. If you happen to be modestly bullish on one of the currency pairs, here's your choices: bull call spread, bull put spread. If you happen to be modestly bearish, here's your choices: bear call and bear put. If you happen to be neutral, if you've got a market that's stuck between support and resistance, and you've got the approval, you can do some kind of a spreads, butterflies, condors. Just call spreads, put spreads. Leg into your spreads. If you're looking for profit not limited but loss limited, you can do straddles. If you're not sure which way it's going to break out, to an uptrend or a downtrend, you can do straddles. And of course, if you're looking for profit limited and loss not limited, if you've got higher approval, you can do some kind of ratio spread. One of the things I like to do is a 2-by-1 ratio spread. If I'm bullish and I also want to hang on to a call for a breakout, I can do that. So if you're level 2 approval only, you can go long near support using long calls. You can go short near resistance using long puts. So when you're trading in this channel, when you come down near the support, go long. When you come up near the resistance, buy puts. If you happen to go 2 long calls down here and 1 put, and you catch some of this move because you're anticipating a higher move, you can hang on to your call for a period of time. If your approval happens to be higher, level 4 or level 5, you can do that, or you can do spreads. You could sell put spreads, you can sell call spreads, especially when you're near support. You can sell put spreads, and you can use the money that you collect to finance long call purchases. Okay? The same thing if you happen to be up here where there's resistance. You could sell the calls above the resistance area and use that money to buy puts. So you have more choices depending on your level of approval. If this is a trending market and you're long, for example, you can buy out of the money calls when price is testing the support here on the breakout. And during this time when it's rallying like this, if you have enough premium, then you can hang on to that call. Otherwise, if you notice you're rallying into any kind of prior price resistance, make sure you're taking your profits. All right, so we're briefly, for the next few minutes, going to look at a couple of the pairs that we have that we like to trade. We see where the Australian dollar versus the US dollar has been making new lows, and of course this is a very, very trendy market, but we did have a little rally last week. So this could set us up for some kind of a sideways channel if those prior weekly lows hold. The spot contract, once again, if it were to break through that support of the prior week's low, then you could probably come down and test the breakout point where the ascending triangle breakout point was. So this could be a market that pulls back a little bit, and if you're long right now, you would want to use the moving average or the previous week's low, this large weekly candle's low, as some kind of a stop loss, just in case the market decides that it wants to top here. Of course, it could base up here and then break out and make new highs. So here it tested our 10 moving average and it bounced, and I believe this week it's rallying a little bit. So definitely, if you don't have a position, look at this as a channeling opportunity near the support and look at it as a channeling opportunity near the resistance. Our dollar versus the British pound came down to our lower support area and has actually bounced a little bit. But it's just bouncing, and it could definitely take those lows out. But I would suggest waiting to go short until I broke below the support area. It's one thing I always tell my traders, anytime I mark support on here, it is support or demand until the sellers overwhelm the buyers. And that would mean we would break through below the support zone and make new lows, but not before. The British pound spot, the ISE British pound spot, actually rallied into this weekly resistance. So this is where we could possibly have some kind of a topping market. If it takes out the support below 162, then you'll probably drop to the 156 support area. And if it manages to rally past the resistance up here where it's currently at, then you'll probably make new highs. The Brazilian real, I would look for support near 157 and resistance near 167. So if the market is going to be sideways between those areas and you have the approval, you can sell the call spreads and the put spreads. And here's the dollar versus the Canadian dollar, and we did hit that 95 support area, and we are beginning to bounce. And there's a lot of people thinking that we will go lower, but if I'm going to go short, it's going to be when I break below my support zone. So you can short a rally up into these downsloping moving averages, but I would suggest shorting rallies higher prices, and if I wanted to go short, it would be below the support low. Here's the euro spot, and we rallied up into the resistance, and if you're somebody that likes to sell strength, you would sell on a rally into the resistance with your stop loss above the highest high. And of course, if you want to sell when it breaks the support area here, which was sell weakness, your profit target is going to be quite a bit smaller. And at this point, it's working on making a head and shoulders. And it did break through, so I would trail my stop loss if I happen to have a position just in case it goes lower. Here's an example of selling a rally into the resistance of the euro up here, the dollar versus the euro, or you have the opportunity to sell the break of support. The difference is the selling of the rally into the resistance is going to get you possibly 6 points for 2 points of risk, whereas the break of the support is only going to get you 2 points for 2 points of risk. So I would suggest in something like that, if you have the personality that allows you to sell rallies into resistance, then I would sell the rally because it becomes a more profitable trade. Okay? And we're coming up on the top of the hour here. So what I would say to you right now is, as I showed you on the earlier slides at the beginning of the presentation, you do have the dollar coming into some kind of support. You've got the dollar coming into support against the euro. And I also want to point out the last slide that we're going to talk about before we take questions. If you're a position trader, you can stay with that short trade, just draw some kind of a trend line. But if you're a swing trader, this would be a perfect opportunity for a potential reversal, and you would probably want to watch to see what the dollar does when it gets back up into this 74 resistance area. And if you hear everybody tell you how the market has to go lower, I just wanted to point out that the ISE euro, the dollar versus the euro, still has a support area on the monthly chart at around 64. So if it does go lower, if it does take the first support area out between 68 and 66, I'm still going to be looking to go long near 64 with a stop below 62. So at that point, I'm going to turn it back over to Katrina.
Yep. All right. So if anyone has any questions right now, if you can just go ahead and type them for Steve in the Q&A window. It looks like we have probably maybe a couple minutes. to cover any specific questions that you may have for him based on today's presentation.
Okay.
Not seeing anything just yet.
I got a few. Thank you very much. Is the webinar archived? It should be archived in a few days, right?
It should be up on www.ise.com/archives.
Wow. Okay, great.
I think we have a question in the
And
chat.
it'll be on our website, too, probably in a few weeks.
Looks like we have a couple questions also in the chat window. We have Mike Chandler asking, what are your moving averages?
Oh, Mike, that's a great question. On the weekly charts, I use the 10-period moving average, and it's a weighted moving average, which means it's much more sensitive to current price than past price. And I use a 30 moving average. And I got those moving averages years and years ago from a gentleman that traded with the 4 stages, and they just are the same moving averages he used in the 1980s, and I'm using them today, and they still work the same. Greed and fear still looks the same today as it did back then.
All right, looks
and
like we
I see
have
a few more people here with questions. Are there any ETFs you could recommend to trade rather than trading FX directly? You could trade the UUP if you're bullish on the U.S. dollar. You could trade the UDN if you're bearish on the U.S. dollar. If you want to trade exchange-traded funds, you'll have less leverage, and you can definitely go ahead and hedge your risk using exchange-traded funds too. Sure.
All right, it looks like that's it for questions for now.
All
right.
right.
Well, then thank you, everyone. Thank you, Steve, for your insights today. Thanks to everyone for joining us. If you'd like to learn more about the ISE FX options that we discussed today, please make sure to visit fxoptions.com. You'll be able to see a full list of the available currency pairs, plus a host of educational resources that we have available on there for free. So you can check out and also sign up for free trade alerts. These are timely recommendations based on what's going on right now in the FX markets. So we hope to see you again at upcoming webinars. To sign up, make sure to visit www.ise.com/webinars. You'll be able to check out the latest schedule. Thanks again, everyone. We will see you next week. Thanks, Steve.
Okay, I'm going to type my email in here before we disconnect. So if anybody wants to send me an email, you can send it to smisic@tradingacademy.com, and I'll answer any questions I can for you. Trading Academy. And I type with a grand total of 2 fingers, so I apologize. So, okay, there you go. smisic@tradingacademy.com. Thanks again, Katrina, and we'll talk to you. Have a great day, everybody. Thanks for coming.
Bye.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.